Slide up. Welcome everybody to tonight's JUMPinar. Just hang in there for a few minutes while we give everybody else a chance to join in, and then we'll get started. Welcome everybody to tonight's JUMPinar. We're just going to give it a few more minutes until some more attendees join in, and then we'll get started. All right, looks like our attendance is leveled off, so I think we're going to go ahead and get started here. Welcome everybody to this Monday's Jumpstart Germantown JUMPinar. Tonight we're going to be watching a recording of Ken Weinstein talking about advanced financing strategy for investing in Philly from Philly Real Estate Week, which happened a few weeks ago. He had spoke at it for 3 years, and this is his third appearance, and they were nice enough to send us the recording, so we're going to share that with you guys. And then after that, at around 7:55 or 8 o'clock, whenever the recording ends, we're going to do a live Q&A with Ken, and he'll be joining in at some point before then. But before that, I just want to go over some housekeeping. There's a Q&A function on the Zoom webinar here. So if you go to the toolbar at the bottom, you can click the Q&A tab and enter in all your questions for Ken, and then Angie and I will sort through them and ask them at the end during the Q&A portion. And we're going to keep the chat disabled for the duration of the video, but towards the end, we'll open it up for a little networking if any of you guys want to reach out for help from other jump starters or anything of that sort. Yeah, so before we get into it, Angie, is there any updates from Jumpstart Germantown?
Just for anyone who hasn't joined us before, we are lending. So Jumpstart Germantown and Jumpstart Philly loan programs are going strong. We've closed on a number of loans during this time and have a lot of applications coming in. So if you have a property and you're wondering if we are doing loans, we are. So you can visit jumpstartgermantown.com or jumpstartphilly.com.
Great. And then if you do have to leave at some point before this session ends, we will have the recordings up available online on jumpstartgermantown.com. And we'll go over how to get that at the end, and we'll also send out a follow-up email. So without further ado, I'm going to switch over to the recording here. Share computer screen. This is the first time we're doing it without a guest speaker, so bear with me. All right, here we go. right, I should be sharing the screen now. And here we go. This is a recording from Ken Weinstein at Philly Real Estate Week 2020.
I think we got it right now. So advanced financing strategies for investing in Philly, that's what we're talking about tonight. And the key word here is advanced. Just to be clear, I'm not going to cover what we cover in the Jumpstart training program for newbie developers. I'm not going to define terms tonight unless I think they need to be defined. Takes, but we're not going to, I'm going to make an assumption here that you have a basic understanding of financial terms. So, and that's an important point because as I talk to bankers and they ask me about my jump starters, they sometimes complain that jump starters or other newbie real estate developers come to them and don't know financing terms. It's really important if you want to be taken seriously that you sound and look like an experienced real estate developer. So if you don't already have the lingo, if you don't already have the knowledge of real estate terms, make sure you do whatever it takes to pick that up. So early financing techniques. Some of these you may have heard about earlier today as part of Philly Real Estate Week. But these are all things that I used and that you probably used as a novice real estate developer. And they're all good, but they all have their downsides. And as an experienced real estate developer, you tend to not use these anymore because of those downsides. So they're all good techniques. I find that most real estate developers who are experienced tend to avoid using these sources, but there's nothing wrong with using them as you get started. Hard money lending is fast and easier approval. It takes days, not weeks, to get approval usually. Usually you can get hard money lending with a lower credit score, but the problem is they're short term. You definitely don't want to use hard money lending long term because of the higher cost. I've seen costs on hard money lending as high as 12% with 5 points. No problem using that for 6 months, 9 months, a year even. You definitely don't want to use it longer than that. Also, typically with hard money lending, not in every case, but very often it comes with a lower LTV ratio, maybe 65%. Instead of a bank loan of 75%. Seller assistance is something, sounds great on the surface. You get to lower your equity contribution, which is a good thing. You get to put a second lien on a property instead of a first lien, typically with seller assistance. But you got a couple of major problems. Some banks won't allow a second lien. So if you do seller assistance, you put a second lien on your property, you may have a harder time finding a bank to give you the first lien. And then very, very likely you're going to pay more for the property. So I see a lot of people saying, hey, I got seller assistance, this is great. Well, it turns out they probably paid 10, 20, 30% more for the property than they would have otherwise. Because think about it, if you're a seller, and somebody comes to you and says, I'll offer you $1 million cash, or somebody comes to you and says, I'll offer you $1 million, but I need you to take back 20%. Well, you're going to sell it to the cash person. So what does that mean? That means that you would probably have to pay $1.2 million and take some seller assist rather than buying for cash and being able to buy it at a lower cost. So just realize that there's a cost and an impact to that. 100% financing, again, sounds great on the surface. And I know it's a technique often used when buying and rehabbing houses in particular. But it tends to take more time. There's less availability. There's less lenders who want to be doing this kind of thing. Ultimately, it costs more. Maybe not in interest, but you would have to give up part of your return Maybe there's higher interest rates, but a lot of times you have to give maybe 10, 20, 30% of the profit up in order to get your 100% financing. I'm saying all these things, by the way, generalities. I know there's probably people listening in tonight says, oh no, that's not the way my 100% financing works. I'm just speaking about in general how it works. Very often there's increased compliance or reporting to others. You might even need to partner with whoever is providing you that 100% financing. So partnerships can be great. I've done very well with partnerships over the years, but they do create less autonomy and less independence than just owning properties yourself, and so you can make 100% of the decisions. Friends and family is one of my favorite. It certainly got me started. Again, no problem. My first 2 properties, I brought in friends and family in order to invest with me. And my brother was one of my investors. And after the second property, I bought him out because, it's just not it's not worth losing friends and family over deals. So I find it can be a great source of funding, especially in the beginning, but it's also a great way to lose friends and family. Again, you need to report to others. It might change your mission or direction, meaning if your friends and family don't agree with the mission or what you're trying to do, you probably have to follow their lead, otherwise they're not going to invest. And then it's, at the end of the day, it's limited resources unless you're related to Bill Gates, Warren Buffett, or Donald Trump. So at some point you run out of friends and family with financing and you have to move on.
Okay, so at this point, Ken goes into Jumpstart Germantown, but we already had a JUMPinar on that a few weeks ago, so we're going to skip ahead until after that section.
That changes as you gain more real estate development experience. So, if you're just getting started, this is all good information to know, but you are probably not going to take advantage of the type of financing that I'm about to talk about. So financing needs change as you gain more real estate development experience. When I started out, I certainly was not aware of these financing techniques and certainly didn't use these financing techniques. So definitely something that you will graduate up to as you get into different types of real estate development. So change is really a gradual process. It doesn't happen overnight. A lot of people, including myself, put their toe in the water. You don't just decide one day, let me stop doing single family homes and start doing larger commercial properties. Well, no, it doesn't work that way. You're doing single family homes and you say, you know what, I think I'm ready to do something else. So let me buy a multifamily property, let me buy a storefront, let me buy a small office building and see how that goes. And if you decide you like it, then maybe you get more into it. So, each person's situation is different, and each person has to figure out if and when they want to change what they do. While I made a change after 10 years in real estate development, some real estate developers never change, and they just do single family homes for the rest of their life, and that's no problem. But if you do change, your financing, the type of financing that you do may also need to change. And it really depends on your overall goals. Are you trying to do real estate fast or, gain? Wow, I had a little tickle in my throat tonight. Are you trying to gain a lot of properties in a short period of time? Or are you trying to take it slow because you have a lot of other stuff on your plate? Are you trying to do it full time or are you trying to do it part time? Do you want to get into residential, want to get into commercial, want to get into multifamily? Are you going to build on spec or are you going to sign leases and then try to get financing? are you mission oriented? Are you committed to affordable housing, historic preservation, flips, holds? Specific funds are available for each of those specific missions. So just as an example, if you decide you want to get into historic preservation, there's going to be financing available for you that wouldn't otherwise be available. What funds do you have available? What can you contribute to equity? What is your credit score? Is it decent enough that you can go to traditional banks, or do you need to find other sources? And what size projects are you going to do? What kind of cash needs do you have, depending on what size projects you're doing? Some general rules that you want to follow when doing financing in a more experienced way. You want to be creative. Very often you're going to need to put together multiple sources and not just one single bank loan. You want to think outside the box. You want to know what's out there. You want to be aggressive. Don't wait. Apply today, not next month. Don't wait till you need the funds in your bank or you're just about there. You're almost at your deadline. Think ahead and apply accordingly. Definitely do follow up with bankers because banks aren't going to, they're busy. They're not always going to follow up with you. So you're going to need to follow up with them. I say this as an optimist, but in financing, you got to be pessimistic. Don't apply for only one source of funding at a time. Assume you're going to be rejected. So go out, apply for 5 different types of financing, and hopefully you'll get one of them. Make sure you're being thorough. Don't apply piecemeal. Assemble your loan packet. It really makes you look professional. Don't send your banker a pro forma one day and tomorrow you send him or her your bio, and the next day you send something else. Put it all together and send it together, and just make their process easier. And last but not least, be informed, be resourceful, look for new funding sources. They're coming out every day. There's always new products out there. Network, read articles, go online and do webinars, podcasts, of course, listen in on PREW events. So what I'm about to show you is various funding methods using past and current Philly office retail projects. This is not meant to be an exhaustive list, but hopefully it'll give you a flavor for financing larger deals. But there's many, many other sources out there that I'm not going to cover tonight that are available to you. So the first very tried and true method, it never gets old, is the PREW method. So hopefully you're already using this as maybe a newer developer, and it's something you never stop using even as an experienced developer. This is a property we bought, I forget, maybe 15 years ago in Mount Airy, Earth Bread and Brewery, 7136 Germantown Avenue. So you all know the PREW method stands for buy, rehab, rent, refinance, and repeat. It's just a really key method and something you're going to keep using unless you have unlimited resources, which most people don't. So it's the way you're going to take money out of your projects. It's the way you're going to leverage resources. It drives new projects. It keeps cash flowing into your operation to pay for your development projects. We are always looking ahead to when our loans are up, whether we think it can appraise higher, whether we can take money out of that project, or whether we have to just sit tight and not take money out of the project. It really depends how properties are appreciating in value. So this one, for example, we paid $325,000 for this building in 2004. We spent $110,000 renovating it into vanilla form. And then the tenant, Earth Bread and Brewery, who's been with us from the beginning, did the fit out for the property. So the result of the PREW method is that we were able to cash out refi $435,000 in 2009. So basically, that gave us 100% financing. And then 9 years later, in 2018, we were able to cash out refi for $717,000, so that we were able to take $283,000 out of the property and put it into our next project. And we just do this over and over again every 5 years. It never ends. So really, the cash out, as I said, is based on properties appreciating in value, but it's also based on getting a favorable appraisal. So that's a whole nother discussion, but anything you can do to figure out how to feed information to your appraiser and get higher value, you will end up getting more cash out of your property, because usually the bank's going to give you about 75% loan to value. Crowdsourcing. So this is something I have not done previously, but wanted to bring up as a good example of what can be done. And in this example, I'm going to use Mosaic Development Partners, Greg Reeves, Leslie Smallwood, who do a real nice job. They bought this property around the corner from a bunch of a dozen projects that we're doing in the Wayne Junction area. And you know, they put together many different sources of financing. We're going to talk about a couple of them tonight. But I thought one of the more impressive ones they did was crowdsourcing. So this is the Gillespie Labs property. They raised $291,000 through crowdsourcing. They had initially set a minimum goal of $100,000 and a maximum goal of $760,000. So they were able to raise $291 right in the middle of the min and max. Their total estimated project cost is $7.2 million on this project, and they raised the $291,000 from 36 investors. Their promise to investors, I shouldn't say promise, because you got to be careful with crowdsourcing. There's a lot of legalities around it. You can't absolutely promise anyone anything. What you can do is set up guidelines and expectations and maybe talk about previous projects and what you were able to pay back to the investors, but you can't promise anyone anything. But what was said in their prospectus was suggested was an 8.5% annual preferred return, a percentage of cash flow, a profit share on any refinance in the future for a 7 to 10 year term. So that's what they put out there. They used a crowdsourcing hosted by smallchange.co, which has been a very popular hosting source. And I was able to hear the head of Small Change speak to potential investors in the Germantown area. So they were very successful with this. Other examples, they did the same thing with another development they did, Sharswood Commons, where they raised $750,000. That was an OZ project and a partnership with Shift Capital. And there's many other examples of how crowdsourcing has been used. Relatively new source of financing. Other platforms besides smallchange.co are Honeycomb, which is honeycombcredit.com. But people are also using GoFundMe, Kickstarter, and other real estate specific sites. So there are other people getting into this business. So the upsides of crowdsourcing are that these funds that you're raising can be used for the equity contribution. So it means that developers can potentially use less cash into the project. And it's also, kudos to Mosaic for using it as a great way to promote community projects and gaining support for development, because they went to the community, they did a presentation that I was fortunate enough to be at to the community. So they were gaining support from the community while encouraging people in the community to give through crowdsourcing. Downsides of this approach are that dollars are raised too late for pre-development expenses, which creates a risky situation. So what it meant for Mosaic is they had to put money into architects, money into maybe environmental, money into maybe selective demo in order to design their project, develop their numbers so that they can go out and raise money through crowdsourcing. It takes more time to develop a financial prospectus, and it takes time and money to follow the legalities. And there's always that risk that people will not invest. But if you know your audience and you know your project, you should be able to determine if people will invest or not. One of my favorite ways of financing projects that certainly you can't do early on is lines of credit. This should really be your goal, to go out and develop any lines of credit you can. You start with a $50,000 line of credit and show your bank you know how to use it, and then eventually you end up with several lines of credit, maybe for millions of dollars each, that you can write a check on, but you don't have to go and apply for. So it's really a key financing tool for the most experienced developers, and it'll really help you take your development to the next level. As I tell jump starters, lines of credit make you a ready, willing, and able buyer, because you don't need to go ask for financing. If you're buying a property for $50,000 and you have a $100,000 line of credit, you can just go ahead and write a check on that line of credit and buy the property. So a very powerful, very flexible loan, typically from a bank or a financial institution. It's a revolving loan, which I really like. So you only pay for the funds you use. If you get a $100,000 line of credit, you don't need to start paying interest on that $100,000 until you write a check against that line of credit. You typically need to have lots of years of real estate development experience and strong credit in order to attract a bank to give you a line of credit. You typically use a personal guarantee, but typically don't need to use real estate as collateral in a line of credit. One of the keys, though, to lines of credit, because interest rates change constantly, it's not like a mortgage. It's not fixed for a 5-year period of time, or if you own a house, 30-year period of time. Your interest rate is changing every month, and you got to be careful. So right now, of course, interest rates are very attractive, but you got to be careful because it's not always going to be that way. So what you don't want to do, what you want to do is line up your type of financing and with the type of development you're doing. So lines of credit are short-term. You want to use it for short-term purposes. If you're doing a long-term mortgage on a property, you can use it for a long-term use. So you want to line up your lines of credit. And really the reason for that is because, as I said, interest rates are nice and low right now, but 3 years from now, they may be through the roof. We just don't know. You know, I grew up and went through the late 70s when interest rates were in the low to mid-teens, and that was a scary period of time, and I'm fortunate I wasn't investing in real estate. But if you tried to finance your property long-term using a line of credit, you're going to be stuck if rates go up to 5, 10, 15%. You want to, if you're going to hold a property long-term, you want to lock in your interest rate long-term. So a typical strategy with lines of credit is you want to use it for acquisition and maybe construction. And then as soon as you're done with construction and find your tenant, then you refinance the property to replenish your line of credit. Another possible approach, particularly for larger properties, is to use it for acquisition only. And then once you sign a lease with a commercial tenant, in my case, then you can go out and borrow against that lease and refinance your line of credit. And I should say replenish your line of credit. So it's, again, meant to be short term. you want to get, if you're using a line of credit, you want to get in and out of the project and then put permanent financing on the property. So this property, for example, we bought this last year. We're still developing the property. We bought the St. Michael's Church campus for $525,000 cash because we used a line of credit. We then subdivided the property into 1, 2, 3 parts. We sold off one of the buildings along Germantown Avenue. So we reduced our cash into the project. And then we signed a lease on the social hall, which is to the right on this picture, for Mount Airy Pediatrics. And we're spending $325,000 right now on fitting out their space for them. Our goal for this property is once we sign a commercial tenant to the 5,000 square foot church, which you're looking at right now, we can then do cash out refinance, replenish our line of credit, and we'll have permanent financing on the property. And very likely we'll have 100% financing on the property. So that's a good example and a good way of using your line of credit. Tax increment financing and DCD low interest loans. DCD is Department of Community and Economic Development for the state. They have a lot of low interest loans and grants that we have accessed over time. And if you're not aware of it, you should definitely go to their website and check out their different offerings. TIFs are not used a lot, but here's a project in Montgomery County where we did use a TIF. What a TIF is you are asking government, in this case, the Norristown Area School District, Montgomery County, and the Borough of Norristown, if they will give up part of future tax revenues and in order to float a bond and give you cash today. It almost sounds too good to be true, but of course, like everything else, there are strings attached. So what that means is, just to give you an example, if we're paying $75,000 a year on the real estate tax bill on this 42,000 square foot property, in this case, the school district was willing to give up 10% or of the tax revenues per year. The county and borough were willing to give up 75% of their tax revenues every year for 20 years. And then what they did was they floated a bond, gave us $525,000 to help us renovate this property because they saw this as a great way to spur development in downtown Norristown. So they really wanted to help us. And then the real estate taxes that they are giving up over that 20-year period then pay for the bond, pay for the interest on that bond over 20 years. And then the whole thing goes away 20 years later. So it took a lot of time in order to make this work. But this was a project that was underwater if we did not pursue the TIF. So it made the project possible. It did help spur economic development in downtown Norristown. So it turned out to be a good thing for the borough, for the county, and for the school district. So downsides, you know, there is a reason why that I have never used the TIF method again, but it is still available. And if we did more projects in suburban counties, I would probably try to use the TIF again. It's a political process. Just to give you an idea, the Norristown Area School District wouldn't have approved this if we were putting apartments in here, because apartments mean there might be school-age kids and they don't have any more room in their schools without building new schools. So they were only willing to do this project because we were putting a theater in the first floor, we were putting a law firm on the fourth floor, we were putting a daycare in there. So it was uses that they wanted to approve. There's high legal fees, as you can imagine. And whether or not you get approved for the TIF, you're going to pay those legal fees. I forget, they were probably 20, 30,000 on this property. And there's a long lead time. It probably took us 6 to 12 months to get this fully approved. So it was not an easy process. But the upside is by getting that $525,000 up front, we were able to half our equity contribution. So instead of putting 25% into the property, we were able to reduce that to 12.5%. So it was very powerful at the end of the day. In terms of the DCD low interest loans, we got 2 of them on this property. They were both for fit out for specific tenants. One was $525,000, 1% interest only, which helped us fit out the first floor and charge lower than market rate rent for Theater Horizon, which really helped to spur Arts Hill in downtown Norristown. We also got another $250,000 1% interest only loan, which helped us complete this building. So the downsides, again, for DCD loans is that they're time consuming, they increase fees, there are lower returns on the back end because even though they're interest only, you have to pay the principal when we sell the property or 20 years later, I believe. The upsides are that for those 20 years, it increases the cash flow by using cheap dollars because there's no amortization. And it also helps you leverage resources. So it can be powerful. I try not to use low interest government loans, to be honest. But when they're necessary and they make your project work, it's something you want to pursue. Next up is historic tax credits, which is I've started to like more and more over the years. We are now starting our 4th historic tax credit project, and I have found them to be appealing and powerful, especially if you're doing the type of mission-oriented work we're trying to do and save properties from the wrecking ball. So this is the Waldorf School that we did a few years ago. And what the historic tax credits are incentives to restore historically significant buildings. The process is complicated. So the best thing you can do is hire a good historic tax credit consultant. We use Bob Powers from Powers and Company, but there's other good historic tax credit consultants out there. But if you find the right one, they will walk you through the process. They will make it doable for you. It involves submitting Part 1, Part 2, Part 3 application to the National Park Service, which is a federal entity. Part 1 is proof that your building is significant. Usually that's the easiest one. Part 2 is the most difficult. You have to show very detailed plans on how you're going to restore the property. And there's usually a lot of give and take with the National Park Service because they're going to want changes. You know, the National Park Service is a higher threshold, a higher level of scrutiny than the Philadelphia Historic Commission. So, you know, if you're already complying with the Philadelphia Historic Commission, there will be additional compliance with the National Park Service. But of course, it's justified because at the end of the day, they are going to give you a tax credit for 20% of construction costs, which can be major. Part 3 is the tax credit consultant documenting the work that was completed as promised to release the tax credits. So once you get these tax credits, you have 2 choices. The first choice is to sell them to a tax credit partner. Usually you get 85, maybe 90 cents on the dollar when you sell them. So there is a cost to selling them. You don't get the full 100% of the tax credit, but when you sell them, you get those tax credits up front. So that's what we did in Norristown with the Courthouse Plaza. What I've been doing more recently is taking the tax credits. If you own a property as part of an LLC, you can take the tax credits and then distribute those tax credits to the owners of the LLC. They pass right through. So in that case, you can take 100% of the tax credits and you can use it against your personal taxes, federal taxes, over a 20-year period. So you just use it gradually. So it's worked very well for us. But the negative of that, of course, is you don't get those funds up front. So most people, unlike us, sell the tax credits and use the money into the project. The Max Levy apartments that you may have seen press on this week in Philadelphia Business Journal is going to be our fourth historic tax credit project, which is pretty exciting. Waldorf, besides the federal tax credits where we got just under $1 million, so it was 20% of total construction over a 2-year period, resulted in $944,000 tax credit. But in addition to that, the state now gives out historic tax credits. So this project, the Waldorf School, was actually the first state tax credit handed out a few years ago. The state initially put $3 million into this program and gave each of 6 regions around the state $500,000. We got half of the money that was offered up to southeastern Pennsylvania. So that was pretty exciting. We have since gotten 2 other state historic tax credits on different projects. There used to be, and some of you may be aware of this, a 10% historic tax credit for renovation of pre-1936 buildings. And it was great because there was very few strings attached. You just had to make sure it was spent on buildings that were originally built before 1936. We used this on probably a dozen properties. Unfortunately, President Trump took it away from us a couple of years ago, so we no longer have that. The upside of historic tax credits is that it's free construction dollars, except for things like sidewalks and driveways and a few other things, landscaping around the building. You are getting historic tax credit for 20% of the whole project. So it's a great way to reduce your construction costs. Projects that were borderline without historic tax credits now work. And that has been true of the 4 projects that we have pursued. The downside is that there are additional strings attached in terms of changing your scope of work. Use Waldorf as an example. We might have put a shingle roof on this property, but the National Park Service did not ask us, they're reasonable, they didn't ask us to put a slate roof back on, which would have been cost prohibitive, but they asked us to use a metal roofing type that looks like slate. So it did cost us, I think the roof might have been 30% more than usual, than if we were just doing a shingle roof. So there can be costs to complying. There's a long lead time, usually 6+ months to get it through the process. There are additional expenses, like I just laid out in the roofing example. So your 20% historic tax credit may end up only being, after expenses, about 15%. And it's not worth going through this process for smaller properties, certainly not for single-family houses. I use a general rule of thumb that construction should be at least $1 million to justify going through the historic tax credit process. Low-income tax credits. This is one I have never used, but we toyed with using with the YWCA building. This is also a great example of not every project gets done. We proposed this project in partnership with Mission First Housing Group and Center in the Park. And the reason for that is I know what I don't know. I didn't know enough about low-income tax credits, very complicated process. So I had one of 2 possible ways of going. Either hire a really good low-income tax credit consultant to walk me through the process, or the strategy I ended up taking, which is hook up with someone like Mission First that has done dozens of these projects to lead the development team and just be a part of that team. So that's the way we went. We put our best foot forward and gave the city a proposal for low-income senior housing, and it was not accepted. I wouldn't be surprised if we get another turn at this building, because the developer they did go with has sat on it for 6 years and not developed it. So I wouldn't be surprised if we see the city put this property back up for bid, and certainly we would make another go of it if that happens. Low-income tax credits are a very competitive process. Not everyone gets approved, and it could take several years to get approved. Rule of thumb that I hear is that you usually have to apply 2 to 3 times before your application is eventually accepted. In this case, it was a $17 million project, or at least that's what we were proposing, and low-income tax credits were going to generate about $12 million of that $17 million in equity. And this project would have been a good example of putting together multiple sources of funding. The remainder of the funding, besides the low-income tax credits, would have come from the city, the Federal Home Loan Bank of Pittsburgh, the city's Office of Housing and Community Development, and a reinvested developer's fee. So very often you have to put together many different sources to make projects like this work, especially if they're low-income tax credit. Opportunity zones. This is one of my new favorites. This is 113 Berkeley Street, which we're just getting started right now with renovating. It's an old factory building, 12,000 square feet. It's going to become Pushpin Studios. For you history buffs, it was the first manufacturer of x-rays in the country, and then later became the Moore Pushpin factory, where they first manufacturer of pushpins. So Opportunity Zone, it was created by the Tax Cut and Job Act of 2017, which was introduced and formulated by Senators Tim Scott of South Carolina and Cory Booker of New Jersey. It's still relatively new. It wasn't until earlier this year that the IRS really issued significant rules and regulations to guide those of us who wanted to use it. So if you're it's new and complicated. So if you're going to use it, make sure you find yourself a good Opportunity Zone attorney and a good CPA who understands opportunity zones to make sure you're complying with all rules and regulations. It's designed to spur economic development in distressed neighborhoods like Wayne Junction. And it goes by census tract. So I believe there's 80 census tracts that are opportunity zones in Philadelphia, to give you an idea. And it goes block by block. So for example, where my offices are located, where I'm sitting right now, in Wayne Junction is not in an opportunity zone, but Berkeley Street is. So it's a little complicated to explain, but let me give it a try. Opportunity zones, what it does is encourages investors to use capital gains from previous investments. Those previous investments could be the sale of a business, could be the sale of a property, could be the sale of stocks and bonds. It could be the sale of anything, could be the sale of artwork, if you're fortunate. So you would take the capital gains from the sale of those investments, and you would put it into an opportunity zone project. And what that does is, one is it defers for a period of up to 10 years, paying capital gains taxes on the sale of that investment that you just made or that you just sold. That's number one. Number two, it can reduce the capital gains on that sale by 10% if you hold your new project for 5 years or more, or by 15% if you hold your new project for 7 years or more. So that's number one and number two. Number three, what it does is it eliminates capital gains taxes on your new project if you hold that project for 10 years or more, which is easy for us because that's what we typically do. We've already purchased this property. We will renovate this property, potentially get historic tax credits also, and then we will lease it out and hold it for 10 years or more, and then never have to pay capital gains on it. So in this case, I took money that we got from the sale of a building at 56 and Chestnut Street that we sold last year. And that sale for me netted $499,000. So we were able to take those funds, put it into a qualified opportunity zone fund and invest it into this project. And therefore I don't have to pay capital gains on it until 10 years or more goes by. So it could be very powerful. The downsides for opportunity zones is you must have capital gains in order to use the program. So if you don't have capital gains, you're not going to be able to make opportunity zone investments. Of course, you can invest, but you won't get any benefits from that. There's limited number of specific areas where you can invest. As I already said, it's limited to 80 census tracts in Philadelphia. The building must be purchased 2018 or after. It was a key rule that the IRS came up with. That being said, there are workarounds if you want to put investments or capital gains into improvements only and not into the building you purchased. So there are different ways of doing this. There are added accounting and legal fees, so you just have to be aware of that up front. The upsides for using opportunity zones is that they can improve your financial performance if you're already investing in distressed areas. So it works really well for us because we're already committed to revitalizing Wayne Junction. So it just helps us make the projects work a little better. For us, it makes borderline projects work because some of these projects we're doing need so much construction that otherwise they either will lose money or they will be break even. But the opportunity zone incentive makes the projects work for us. And what I love about opportunity zones is it focuses investment dollars on areas that need it most, that were previously disinvested or redlined over the years. So new market tax credits. This is again, a financing technique I don't know as much about. We did use it on the Schaefer School, which is our offices in Wayne Junction. It's designed for larger projects in low-income neighborhoods, but the projects must benefit the community. It's a great way to finance acquisition and construction of impactful projects. PIDC, Philadelphia Industrial Development Corporation, has really been the leader in using new market tax credits, but there are a lot of banks out there that receive annual new market tax credit allocations from the federal government. So PIDC over the years has deployed $202 million in new market tax credits to 20 projects around the city. It's competitive, it's complicated, but if you find the right bank or institution, they can walk you through new market tax credit process. So for us, we didn't need as much expertise in new market tax credits because PIDC was smart enough to take $7 million from their allocation and support 4 smaller projects, including this one at 4701 Germantown, but also Golaski Labs that you saw earlier that Mosaic Partners undertook. But the 4 projects that they did were not big enough on their own to qualify for new market tax credits, but they were able to use $7 million and divide that into 4 and make 4 smaller projects work. We were able to lower our interest rate. We were able to get more funding out of the project. And by the way, and I'm not going to cover it tonight, but PIDC has a number of other great loan programs that can help make larger development projects work, such as gap financing. So definitely check out their website and see what they have available. Patient money, one of my favorites. Patient money is something I've always been aware of, but it's a term that I learned a couple years ago from Jim Barnett from the West Philly Financial Services. We were fortunate enough to hook up with LISC, which is a local nonprofit, and the CDFI, a community development financial institution, which gave us a $1.25 million line of credit as a revolving patient money source. So the reason for this is pre-2008, you were able to fairly easily buy a property on what they call spec. You know, you're able to buy a property that needed to be renovated, and the bank would loan you money for you to buy that property and for you to renovate that property and wait for tenants. Well, after the 2008 recession and the housing bubble burst, those loans went away. Those were way too risky. Banks should not have been doing those loans. So that's why patient money is so important, because it allows a more experienced developer like me to buy a property and have it financed. In this case, LISC gives us 65%. So if we, for example, and what you're looking at is 4518 Wayne Avenue in Wayne Junction, this is what we want the project to look like eventually. But right now it's ugly vacant land. But we were able to buy that land for $350,000 and LISC financed 65% of it. So we only had to put 35% down. And we can hold it for several years until a project like this comes to fruition. So it's very powerful, gives us a lot of flexibility. In order to get patient money, you need to offer up a personal guarantee. You need to offer up first lien position on real estate purchased. But it allows you to buy properties that don't have any cash flow and that you don't have your game plan together yet. It also allows you to be more aggressive as a buyer, knowing that you have patient money behind you. So as we do these projects and we refinance them, we pay LISC back, and that allows us more room on our patient money line of credit so that we can then buy other properties. So it really pays to have a track record and a positive mission, because otherwise LISC wouldn't be lending us this money. And in fact, we were the first for-profit in Philadelphia to receive patient money from LISC Philly. So a couple more methods, we're getting there. Private investors and funds. This is something that a lot of experienced developers used. I have not used this. So I wanted to give you examples that Shift Capital and Ironstone, two of my favorite developers who are mission-oriented, have used in the past. Shift Capital has a Shift Neighborhood Fund, which is urban value-added strategy. That's their focus. They raised $20 million, and now they're trying to raise, or maybe they're done with it by now, an additional $20 to $30 million investment. Over the life of the fund, they are suggesting that investors will be paid 2.5x to 3.5x. So if you make a $1 million investment into their fund, over the life of the fund, they're suggesting that you'll get $2.5 to $3.5 million back on your investment. The target area for this investment is Broad and Erie and Kensington, which is mostly where Shift has been focusing their attention. But I was impressed with this fund enough that I put some capital into this fund, and so I hope it does very well. Ironstone Investment Fund, Ironstone Partners, has had several funds, and they're the first years ago of anyone I've known who have done a private investor fund. They've done very well with it. So their strategy, their purpose was to buy defaulted first mortgage liens on multifamily properties, invest in mixed-use properties as well as historic buildings. Ironstone focused on adaptive reuse, similar to what we do, of older buildings and densely populated older city neighborhoods. So their largest project to date, you probably read in the newspapers, at 46 and Market. They're about to redo the Provincial building. It's got hundreds of thousands of square feet, and they're just the right developer to take that on. In 2005, they raised $10 million for their first investment fund. That grew to $33 million for their second fund. And in 2012, they raised $75 million for their third fund for distressed real estate properties. So they've done very well with putting together funds and using them. The upsides on putting together a fund and using it is it provides flexibility to purchase larger properties for cash, which both of these companies have done well with. It makes the developer a more competitive buyer. They can move quickly without needing bank approval. They don't need anyone to say yes. Their board can just decide that, hey, this is something we want to pursue. And the general partner or the developer can get a bigger piece of the pie or higher returns. As you can imagine, not every partner is equal. So the general partner, when there's payouts, are going to make out better if they are the general partner on a fund rather than the passive investor. The downsides are that you have to take on partners who expect returns commensurate with risk. So the investors are not doing this for their health. They expect significant returns, especially if you're buying distressed properties, which have higher risk. You're going to expect higher returns on those investments. It may limit the type of real estate you pursue. As you just heard with both Shift and Ironstone, they have purpose and strategies, and may also end up limiting your mission. So you just have to be aware of that. But this is also a potential source even for small single-family investors. You might find a partner who wants to get into your project, and if it works out well and they get a decent return, they're going to want to follow you and finance each of your projects. So last but not least is bank, broker, and funder relationships. These guys look really animated. I would like to know what they're talking about. You want to be careful when you're working with banks. I mean, nothing wrong with having a favored bank that you go back to over and over again because they make it easy on you. The banker buys you dinner. Their rates are good, you know, whatever. They just make it easy for you. But you don't want to put all your eggs into one basket. Times change, and so do bankers. One of those times is right now, obviously, with today's recession. There's something called zombie banks, but banks can run out of money. And they're called zombie banks because they run out of money and they stop lending. Also, conservative banks stop lending during economic downturns like right now. So right now, even though I have my go-to banks, I'm fortunate that I have good relationships with 10 major banks, so that if one or two don't give me financing or refinancing on a property, I'm able to go to other banks and bankers in my network. So you want to make sure you're keeping an active network. You want many relationships in order to always have capital accessible. Keep strong relationships with your bankers. Keep a high credit score. People always say, what should that be? I would say at least 700 and hopefully even higher. The higher your credit score, the more bankers are going to trust you and the more likely that they can sell your borderline projects to their loan committee. Make sure you keep enough liquidity in a bank or in some source, because banks are going to look for that. And you want to maintain a strong reputation. They're going to check your experience. They may look at some of your properties to make sure they're high quality enough. An example of this is when I was with Valley Green Bank, the loan officers would do social media checks. So they would check you out, they would check your character. As you can imagine, there's a lot on social media. So just be careful what you're posting and what you have out there so that your reputation is strong. Keep a few bankers, brokers, and funders in your back pocket for a rainy day. So I hope that you have found this information to be useful.
All right. And with that, we're going to transition from a couple weeks ago Ken to present day Ken. I'm going to start his video now, and he's going to introduce himself, and we'll get into some question and answer. You can do that by using the Q&A function on Zoom. Just click the Q&A tab, and you'll be able to type in your questions, and we'll review them and ask them to Ken as they come up. But first, I want to give Ken a chance to introduce himself, and thanks for that awesome presentation, Ken.
Thank you. Little strange to give a presentation a couple weeks ago and then come back for Q&A, but
Right.
everything is possible in this pandemic age. So
That's
thanks for having me, Derek.
This is as close as we're going to get to having you in the flesh. All right, so the first question I have for you actually came via email, and this will hopefully get us started so the rest of the attendees can enter their questions into the Q&A. But this has come, I don't know who this comes from, but it was over email before the session started. They're asking, what is the best way you can go after a small business loan in order to secure additional funding to grow your portfolio?
Best way to get a small business loan. I mean, we're talking more about real estate loans here, and obviously there are small business loans harder to get during this pandemic. You have to go fishing for a small business loan. But just to be clear, small business loan is very different than a real estate loan, because typically a small business loan is not collateralized by real estate. It's usually collateralized by your business and what your business owns. If you have a track record in that business or that type of business, it's obviously easier to get than if you don't have a track record and you're a complete startup. In that case, you may need to go to the SBA, the Small Business Small Business Administration, and which usually you access through a bank.
Okay, cool. All right, so now we have a couple questions from live viewers here. Byron Ryan is asking, can you give an example of a short-term project that is used as a line of credit? And that was something that would work, an example of how lines of credit could work on a short-term project.
Sure. Boil it down for a single family home. Instead of, if you had a line of credit, instead of using hard money or a jumpstart loan, what you would do is buy that single family house that needs to be renovated for $50,000. All you need to do if you had a line of credit is to write a check off that line of credit for settlement. And then as you're renovating the building, you're using, again, that line of credit to pay for the improvements, to pay for your materials, to pay for your labor. And at the end, maybe your construction cost is $100,000, so you're into your line of credit for $150,000. If you're doing a buy and hold, you then will do a cash out refi and pay off that line of credit. If you're doing a buy, rehab, and sell, you'll sell the house and then again return that $150,000 to the line of credit and put the rest in your pocket for the next project.
Great.
So you always want to repay your line of credit at the end of the project. Otherwise, you're you'll burn through it very quickly, and you won't be able to do a next project with it.
It's something that takes a lot of effort to get set up in the first place, so you don't want to just forget about it and let it go back behind you. Okay, next is a question from Sean Bailey asking, what advice or direction can you give to a new entrepreneur in the first few years of a business to build capital and trusted relationships with banks? So again, sort of tangential to real estate, but maybe you have some insight.
No, it's a great question. And I think I answered part of it in the presentation, but you really want to develop relationships. Banking is all about relationships, even in today's age of technology and you always go back there. Bankers, because of the Patriot Act, have something called Know Your Customer. They legally have to get to know you and know what you're all about and be in touch with your world and your work. So they want that relationship, and that's what they're paid to do. So establish a relationship with your banker, get to know them, show them your projects, make them your advocate so that if and when they have to go to loan committee on your behalf, they will say to the loan committee, I know this person, I've seen his or her projects, and I know that they do good work. That's what you want. So, how do you get this thing set up initially? You put together a really good packet of information that shows who you are, your bio, your background, everything that they should know about you. Put it into a folder and hand it to them. And then, as I always say, look and sound like an experienced real estate developer. Make sure you know your terms so that when you're talking to the banker, they know that you're newer to the business, but they forget that very quickly because you know all the terms involved.
Sure. Great. And I just want to remind people again that they can submit questions using the Q&A function. You just got to click the Q&A tab and you'll be able to input your question there and we'll see it. We're getting just a few of them, which I guess means, Ken, you must have covered all the topics really well and in detail. So I guess it's kind of a good and a bad thing. So this is from an anonymous attendee. They're asking, where can they find opportunity zones in Philly? Do you know any off the top of your head, or is there a way you can find them online?
Yeah, I don't know the website offhand, but I'm sure if you Google opportunity zones in Philadelphia, you will find some good interactive maps. There's maps out there where you can type an address in. It'll tell you if you're in an OZ. There's maps out there that show neighborhoods with the OZs clearly drawn. And that's how you know that one side of the street is in the OZ, one side of the street is out of the OZ. I just don't know the website offhand, but they are clear.
Okay.
I'm going to guess that if you go to PIDC's website, that they probably link to one of these interactive maps.
Okay, cool. So we have Stefan Williams asking, how do you feel about the direction of investing in Germantown real estate now and in the next 5 years? And it's a pretty general question, but I guess if you want to summarize all these strategies and how they relate to where your focus is in Germantown, what do you think it's looking like in the next couple of years?
Yeah, good questions, Stefan. It really depends on what your goals are. Obviously, I'm still very positive about Germantown. We are seeing a significant price increase right now, but we're seeing that in several other neighborhoods also. But what brought me to Germantown 30 some years ago, fortunately and unfortunately still exists today. And that is that there's opportunities. There are blighted properties that still need to be renovated, that need to be turned over to either tenants or homeowners. And as long as there are those opportunities, there will be work for us in Germantown. There's still a lot of work on the commercial corridors if you want to get into mixed use properties. And there's still, from a development standpoint, there's still margins. I mean, we are getting dozens of Jumpstart applications every month from people that are finding these opportunities, that are doing their pro formas and seeing that if you buy and renovate a property, that you can sell it for 10, 20% more than that. If you buy and renovate a property, you can rent it out and make at least a 10% annual return. So those opportunities are out there. Certainly Germantown's not the only neighborhood where there's opportunity, but it may be one of the most consistent neighborhoods over the 30 years that I've been watching it. 5 years from now, I wish I had a crystal ball and could tell you.
Sure.
My personal hope for Germantown and the neighborhoods around Germantown is that blight has been removed from the neighborhoods and everything has been renovated and is fully occupied. But I have a feeling that we're going to fall short of that goal and that there will still be opportunities available 5 years from now. But I think it's an ideal neighborhood to invest in, and I think prices will continue to increase, hopefully not through the roof, so that it stays affordable.
Mm-hmm. Yeah, and there's sort of a cyclical nature to it, I guess. So there's neighborhoods that are doing great right now, but maybe in 5 years, there's properties that are abandoned and left over. So even you're not even looking for opportunity, but you're looking for downfall, you know?
Right.
Okay, another 2 questions here. One's from another, I don't know why people submit questions anonymously, but this one says, what's the best way to find an experienced real estate attorney that is aware of the various alternative financing strategies that you discussed?
Ask them. Obviously, ask around. Referrals are always the best way, I think, to find an attorney. You know, if you look at their reviews online, everyone looks wonderful. So use the Jumpstart Germantown Facebook page. Use some of these other investor Facebook page. Find out who people are using, but be specific in your question. I see a lot of questions on Facebook. Hey, anyone have a good contractor? Hey, does anyone have a good attorney? No, you're asking the wrong question. The question for you should be, is anyone working with an attorney who is really creative and knowledgeable about different financing techniques? And that's who you want to use. What I find personally, and I'm sure that there's attorneys out there that have a nice repertoire of financing techniques, but I find that attorneys are very specific. They know new market tax credits really well, or they know opportunity zones very well, and they specialize in those areas. That's how I have used attorneys over time. I have a general attorney, but right now I have an OZ attorney, and I have used new market tax credit attorneys. I've used TIF attorneys. Mm-hmm. So I think that that's more likely that you'll find attorneys specializing.
Cool. Great. And this looks like our last question for now. Do you have any suggestions on obtaining lines of credits for newer developers? They say they found one lender offering unsecured letter of commitments, but only up to $20,000. Others require collateral. Is this usually the case? And is this should this be considered while starting off?
Yes.
Okay.
Someone's offering you $20,000, take it. And if you use it well, hopefully it'll be up to 50 next year, and hopefully it'll be up to 100 the year after. I mean, just take it, grow it. And even if you take it, you know, don't assume that that bank will increase it. Go look for other banks. Mm-hmm. I had a bank a few years ago that I knew well that would not increase my line of credit anymore. So we went to Republic Bank, gave me a nice line of credit, and we're still there today. So it's why you have multiple relationships with different banks, because you don't know what they're going to do in the future. Should you start off with offering up collateral? If that's what they ask of you and you have collateral to offer up, yes. But at some point you should expect them to make it into a unsecured loan, because that's what banks are doing for more experienced developers. Get too impatient. It took me years to develop a relationship with my bank to the point where I could get a line of credit. Until then, you're just going to have to keep getting loans on each and every line, on each and every property that you're buying and renovating. and eventually you'll get to that point.
Okay, great. Well, I see Angie just put in the chat there the link to the opportunity zone map that you can click on and type the address in and find those properties. So whoever asked that question, or if anybody else is interested, just look in the chat there and the link should be sent by Angie. And
Looks like we have one more question, Derek.
Yep, that just popped up. They're asking, is there a line of credit interest rate range that they should look for?
Yeah, that's interesting. Lines of credit, and I think I said this in the presentation, so you want to be careful. If you get a line of credit, it's short term, and you only want to use it for types of development that are short term. For example, you don't want to buy a stabilized property that you're going to hold for 10 years and get a short-term line of credit. I'm saying all this because lines of credit are priced to change usually every month. Sometimes it's even every week. And it's typically LIBOR rate plus a certain amount of points, or it's prime rate plus a certain amount of points. That's a long way of saying every line of credit is different. I've had lines of credit that are prime minus half a point. I've had lines of credit that are prime plus 1.5 points. It seems these days that, and I don't understand financially enough about this, but it seems that they work off of the LIBOR rate more than they work off of the prime rate these days. It must be a trend going on. But they really are all over the place, and that's why you shop around.
Okay, great. And here's another question here, or two more. They keep coming in. This is from Lexi. She's asking, I have a property that is 98% rehabbed and is free and clear. Should she be able to get a HE line of credit, not a mortgage on this at this point? I'm not sure. HELOC. Do you know what that's?
Yeah, yes, a line of credit, yes. 98% rehabbed is free and clear, and I assume Lexi's holding it. So wondering if it's get a line of credit. Yes, you can do that. Again, I think your goal should be to try to get a line of credit that is unsecured, because ideally you would do cash out refinancing. I'm going to actually take that a step back. Again, Lexi, if
she's saying she wants
to flip in the next few months. Got it. Okay. So that's why you're suggesting a short-term line of credit, because you're going to be holding short-term. Yeah, a line of credit has less fees associated with it. So if you know you're going to be flipping it, you may not want to pay 1 or 2 points for a stabilized loan with appraisal fee, with everything else involved. So a line of credit might make a lot of sense. The problem is once you get that line of credit, you're going to want to use that line of credit. And if you're only holding this property for another 6 months and then you're going to flip it, that line of credit goes away at that point and has to be paid off. So there's not a lot of room. You could buy a property, but again, you're going to have to pay it off when you flip that property. So it's not ideal to do that.
Gotcha. All right. And last but not least, we have a question from Byron here again. For a long-term hold, what do you suggest we present to a bank when seeking refinancing the property for a mortgage?
If you go to the Jumpstart Germantown website and take a look at our workbook, there is a whole list of items that you should be presenting to your bank. You want to put all those items together in a folder, present them all at once so you're not offering your banker information piecemeal, which they never like. They want to see your whole packet, and again, makes you professional. So take a look at the jumpstartgermantown.com, look for the workbook, and you will find that list, which was put together by Bill Pounds at Republic Bank.
Okay, great. Well, thank you so much, Ken, for hopping in here at the end and doing a little live Q&A. I just want to give everybody still listening here a little sneak peek of what's coming up. On August 10th, we have a presentation from Ugo Opera, who is a frequenter of the Jumpstart Germantown and Jumpstart Philly loan application process. He's going to be presenting on how to work with an investor-friendly realtor, talking about finding comps in good neighbors and or in good neighborhoods, and the block by block nature of Philadelphia and how you can kind of navigate through that when looking for comps. And then next, or 2 Mondays from now on August 17th, we have Next Steps, Tips for a Growing Real Estate Developer with Dan Harvey. So,
Awesome.
Yep, so stay tuned for more information about those. We'll probably be sending out the constant contact emails as well as posting on Facebook and our events page on the website. So keep an eye out for that. And as always, you can watch the recordings of these JUMPinars on jumpstartgermantown.com/JUMPinars. You can just go right there and click the link and it'll bring you up, or it'll bring up the page in a browser, and you can review the recording as many times as you want. So this will be a recording of a recording, which should be interesting, but it works nonetheless. So yeah, I think that's about it. And we're right up against our time restraint here at 8:30. So
Great.
thank Ken so much. And
Yeah, I just wanted to say thank you to Derek and Angie for making all these JUMPinars available. I know people really appreciate and enjoy them. So thank you very much for doing that.
Yeah, and thank you to everybody who is staying watching live now, because there's a correlation between people figuring out, oh, I can just watch it the next morning on on the page. But thank you to everybody who's live, and having the live Q&A I think is beneficial. So yeah, that's great.
Go Sixers.
Yes, go Sixers. All right, thanks everybody.
Thanks, Derek.
See ya.
Bye-bye.